Would you like to own shares in a truly world-class company? Want a market-beating yield and double-digit dividend growth? Looking for a good deal on a great stock? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a massive asset manager profiting from the aggregate economic growth of the world. Pop quiz: is the world's economy going to be bigger or smaller 10 years from now? It's almost certainly going to be much larger as the world's population continues to grow bigger. So companies directly invested in the collective sum of the world's growing output are going to make a lot of money. And that means lots of growing dividends. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of BlackRock Inc., which appear to be trading at a significant discount today. BlackRock Inc., stock ticker BLK, is a multinational investment management corporation. Founded in 1988, BlackRock is now a $117 billion by market cap investment management behemoth that employs 18,000 people. With approximately $10 trillion in assets under management, BlackRock is the largest asset manager in the world. BlackRock has a wonderful business model. Asset management is highly appealing because of its structure. Like all other asset managers, BlackRock charges fees to manage assets, and the fee base is exponentially rising. That's because BlackRock has tremendous exposure to global equities. Global equities are compounding as the planet's population grows and our collective economic output rises. The fee base is compounding. In turn, BlackRock's fees are compounding. Now, this concept might seem intuitive, but it's a concept that's supercharged for BlackRock due to their immense scale. BlackRock is sitting in a rising tide, global capital markets, which is lifting all boats, participants in said capital markets. However, being the largest boat in that tide, BlackRock stands to disproportionately benefit from this. Obviously, this sets them up to continue increasing the revenue, profit, and dividend for years and years into the future. Already, BlackRock has increased its dividend for 13 consecutive years. They're off to a great start. The 10-year dividend growth rate is 11.6%. While that's solid in and of itself, there's been a pronounced acceleration in the dividend growth. The most recent dividend increase was over 18%. This has helped to push the yield up to 2.5%. That's almost twice as high as the broader market's yield. It's also 20 basis points higher than the stock's own 5-year average yield. And the payout ratio is 51.9%, which is almost a perfect balance between retaining earnings for growth and returning money back to shareholders, giving the company plenty of room for future dividend increases. I really like dividend growth stocks and what I refer to as a sweet spot. That's a yield of between 2.5% and 3.5% paired with high single-digit or better dividend growth. The yield is on the low end of that range, but the incredible dividend growth more than makes up for it. Looking at business growth, BlackRock increased its revenue from $9.3 billion in fiscal year 2012 to $19.4 billion in fiscal year 2021. That's a compound annual growth rate of 8.5%. I usually look for a mid-single-digit top-line growth rate from a mature company, and BlackRock is very mature. They vastly exceeded my expectations here. Meanwhile, they grew earnings per share from $13.79 to $38.22 over this period, which is a compound annual growth rate of 12.0%. A 13% reduction in the outstanding share count helped to drive a lot of this excess bottom-line growth. We can now see where all of that double-digit dividend growth came from over the last decade. Similar EPS growth propelled it. In fact, the two growth rates are almost identical, which shows a lot of prudence and intentionality from management. Looking forward, CFRA is predicting that BlackRock will grow its earnings per share at a compound annual rate of 13% over the next 3 years. This is not far off from what BlackRock has done over the last decade. CFRA is clearly assuming a continuation of the status quo. Two complementary aspects of the business separate BlackRock from a lot of other large asset managers out there. First, they sport healthy net inflows in an industry that has seen the rise of passive ETFs leading to outflows. This is a secular challenge that only a few asset managers have been able to successfully navigate. CFRA calls this out, saying it's their view, quote, that BlackRock's top-tier position in passive investments and strong fund performance will attract assets at above industry average rates over the next few years, despite competitive pressures and secular challenges within the asset management industry, unquote. Here's some perspective on that. BlackRock reported $540 billion in net inflows for fiscal year 2021, which is spectacular. Second, and related to the first point, BlackRock has been able to balance active strategies with ETFs so as to cater to numerous client types and investment styles. They capture capital either way. With capital flowing toward ETFs, BlackRock still benefits through their ownership of iShares. They're the largest ETF provider in the world. CFRA sums it up nicely, and I quote, despite a more conservative outlook for asset appreciation in 2022, we think BlackRock's product mix, technology platforms, and capabilities leave it well positioned to remain a best-in-class asset manager, unquote. What this means to me is that BlackRock is situated to continue producing double-digit earnings per share and dividend growth for the foreseeable future, and you're stacking that on top of a 2.5% starting yield. Hard to complain about that. Moving over to the balance sheet, BlackRock has a stellar financial position. The long-term debt-to-equity ratio is 0.2, while the interest coverage ratio is at 40. Profitability is highly robust, which isn't surprising when you're talking about the largest asset manager in the world. Over the last 5 years, the firm has averaged annual net margin of 32.1% and annual return on equity of 14.3%. BlackRock has excellent fundamentals across the board, and the company does have durable competitive advantages that include huge scale, a sticky asset base, a diversified product mix, and global brand recognition. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. I view the business model as somewhat of a risk in and of itself due to the exposure to global capital markets and the associated volatility. The company has economic cycle risk. A recession would hurt asset valuations, which would then likely lower AUM, fees, and profits. The shift from active to passive strategies moves capital away from higher fee products, although BlackRock's leadership in ETFs mitigates this risk to a degree by keeping capital in-house. BlackRock is also steering down the law of large numbers. Their AUM base is so massive in absolute terms that it's challenging to grow at a high rate in relative percentage terms. These are important risks to consider, but I think BlackRock's quality and positioning more than offset them. And with the stock 20% off of its 52-week high, the valuation has become attractive. The price-to-earnings ratio is 20.5. That's lower than the market's earnings multiple. The price-to-cash flow ratio of 24.2 is also considerably lower than its own 5-year average of 27.7. And the yield, as noted earlier, is higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. That dividend growth rate is at the high end of the scale, but I think BlackRock deserves it from every angle. This is lower than the company's demonstrated long-term dividend growth and earnings per share growth, and there's even been a recent acceleration in dividend growth. The near-term forecast for EPS growth is also quite a bit higher than this number. I view BlackRock as more likely to greatly exceed this number over the near term. However, I would expect that growth to moderate and then average out when looking out decades into the future. The dividend discount model analysis gives me a fair value of $1,054.08. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates BlackRock as a 4-star stock with a fair value estimate of $1,000. CFRA rates BlackRock as a 5-star strong buy with a 12-month target price of $1,010. We have a very tight consensus this time around. Averaging the three numbers out gives us a final valuation of $1,021.36, which would indicate the stock is possibly 30% undervalued. Here's the bottom line, guys. BlackRock Inc. is a high-quality company in every fundamental way that matters. They're set to capture and profit from the collective sum of the world's growing economic output. With a market-beating yield, double-digit dividend growth, a moderate payout ratio, 13 consecutive years of dividend increases, and the potential that shares are 30% undervalued, this could be one of the best long-term opportunities in the market for dividend growth investors. And now for a special news announcement. Since February 1st, Lockheed Martin Corporation, stock ticker LMT, has bagged more than $1.6 billion in new contracts and incentive modifications, culminating with a $372 million modification announced only days ago. And we're not even done with February yet. This defense and aerospace company has an almost unlimited runway in front of it, pun intended. This is one of my top 5 stocks for 2022, but there could be a lot more to come, even though it's already up 9% year to date. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.